The street is betting on cuts in the first half of the year, and so far, the Fed is showing that it may actually happen. Investors pricing in 6 quarter-point rate cuts in 2024 by the Fed here. Now, JP Morgan now seeing the first cut in June, pulling its forecast earlier than what it had initially expected in July. What more can we expect from the markets in 2024 as we get closer to those potential cuts, and whether or not this optimism is warranted? Sam Stovall, he's CFRA's chief investment strategist, joining us now. And Sam, it's great to see you here. So let's talk about this optimism that we are seeing, the massive rally that we got on the back of the press conference from Jay Powell last week. Was that a bit of, was that reaction warranted, do you think?
Well, I think it was warranted because Wall Street had been guessing that the Fed was finished raising rates and then guessing that they would start to cut rates in 2024. Usually most estimates were for the second quarter, but now pushed into the first quarter. So when Fed Chair Powell actually sort of admitted that they're done raising rates, that we are most likely to be in a soft landing scenario, and that the Fed is discussing as many as 3 rate cuts in 2024, I think basically it took the lid off of the market's concerns and allowed it to shoot higher.
Okay, and so where then are the best places to be in the market if we do see 3 or more rate cuts in 2024?
Well, between the last rate hike and the first rate cut, the S&P has gained about 14% with all sectors, all styles, and almost all sub-industries in positive territory. And not surprisingly, financials and real estate have been on the top because those are the ones that had been pressured the most because of the higher rates, et cetera. So many of those diversified banks, regional banks that had been pressured because of the sell-off back in March, as well as just overall concerns of a potential recession that, at least for the near term, has been lifted.
So what are some of your top investment themes as we head into the new year? Obviously, the Fed being the massive driver of the markets here as we count down the final weeks of the year. Looking ahead to 2024, what do you have? What's top of mind?
Well, obviously, the Fed is the first one. Also, we are in the second year of this bull market. And since World War II, second-year bulls have added 12.5% to the stock market's advance. So that is fairly encouraging. Also, we're taking a look at the presidential election year that's coming up. So first-term presidencies since World War II, their election year returns have been 15.5% on a total return basis with 0 declines. So not a guarantee, but certainly a very encouraging statistic that this market certainly has further to run.
If we do see a shift in the balance of power towards the end of the year, how would the markets, and when would they begin to perhaps price that in?
Well, interestingly enough, the full year is still positive whether the incumbent has been reelected or replaced. Certainly, an unknown quantity adds a bit of uncertainty into the marketplace. So we traditionally would see a bit of a softening of the market's advance after the election day has occurred. But in general, investors are still optimistic for the full year.
Sam, one of the strong points that maybe some of those who are a little bit more skeptic about the market's momentum heading into the new year has been the narrow breadth that we have seen in the market this year, specifically Magnificent Seven. We've been talking about it now for months, dominating much of that action. Do you still see more upside for many of these mega cap tech names?
Well, interesting. You've got a couple of questions wrapped into that one. First off, we have been seeing a pretty significant broadening of the market. Now we're looking at nearly 90% of the 153 sub-industries in the S&P 1500 that are above their 50-day moving average, and about 2/3 are above both their 50 and their 200-day moving average. I basically like to tell investors that following an up year, you want to stick with your winners. Let your winners ride, which is in reverse of last year when we were down. You tend to want to go from first to worst, meaning buy those groups that were beaten up the most. So consumer discretionary, communication services, technology, which were basically the Magnificent Seven, are likely to outperform the market in the year ahead. But if you want to be a little more cautious, then look toward the second tier of those companies companies within those sectors and sub-industries that did the best.
You got some people out there, Sam, that just want to throw caution to the wind, though, and they want to see where within other regions, other pockets of the world, they could see some outperformance next year. And we've heard emerging markets brought up a few times on this show. Just wondering from your perspective, if there are investors who are looking at any international opportunities, given some of the themes that you believe will continue to prevail, where they are right now.
Well, good question, because a lot of investors are very parochial by nature. And if they are going to look to go beyond the S&P 500, certainly you have an awful lot of attractiveness in relative PE ratios for mid and small cap stocks, each of which is down more than 30% or at a 30% discount to the average to the S&P 500. But developed international is at about a 20% discount to the S&P 500's PE over the last 20 years. Emerging markets have actually held up relatively well, but I think that because the international arena has underperformed the domestic arena for many, many years, reversion to the mean could kick in. Also, if DXY, the US dollar, is showing some weakness because of the likelihood that the Fed is done raising rates, then I think that overseas investments do actually offer an awful lot of appeal to investors today.